how many times you've thought to yourself, man, I'm making more money now, but I can't get ahead, or where's all my money going? I hear this all the time. And it reminds me of what Nelson said is once we know what the problem is, then we'll know what to do, which then also allows us to ignore a lot of the noise. Because everybody thinks I got to go get a higher rate of return, I got to go make more money. In reality, if we build ways to keep more of our money,
the reason that is there and the reason we have to have a cost basis is because of the way life insurance is taxed, and they are classified as return of premium due to cost of basis for the what's called FIFO method in tax, first in, first out. And so what that means is, yes, they are classified as return of premium. I would say that it can be debunked because you can get back more than what you've paid into it in dividends.
And make no mistake about it, we all deposit money somewhere. We all will deposit money somewhere until the day we die, for some medium of exchange, somewhere. The question is how much of it will you control, be able to reuse and pass to your next generation and your next priorities as you're doing that and making those deposits, or premiums, as we would say in the world of insurance.
Welcome to the Cashflow Legendz podcast with your hosts, Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show.
Welcome back to Cashflow Legendz. Nate and Brock and I are very excited to be here today. What a privilege it is. We always talk about this, to be able to hit record and share this. We talk about these things anyway if we weren't hitting record. I'll never forget, I was visiting with Brock's dad, Trent, probably close to a year ago, and he said something that I think he got from Garrett, or maybe he said himself, I can't remember for sure, about how cool is it that we have technology now that can document for our children, kind of a living document of what we did and where we were and what we were thinking. And I chuckled to myself because when I think about that, guys, now I'm not too worried about it, but I am so grateful, Nate, that wasn't possible when we were in our 15 to 25-year-old stages of life, like Brock.
All right,
coming out of
Nate Bargatze is my favorite comedian, and one of his bits was talking about how he's so glad that there wasn't social media around when he was in high school. He said, because everything I did is just a rumor.
That is so true. Brock, I was reading an article about how Nate and I are kind of in that gap of what technology was and what technology has become based off of our ages. And you have only been in the gap not in the gap, but you've only been pretty much in the area of, you've seen technology at a certain level from the get-go. You've been connected. What do you remember your first thing that was technology related that you remember, and at what age were you?
I do remember. I think we're getting some timelines mixed up. I'm not that young.
Well, I know, but what are you, 27?
So when I was in the 5th grade, the first touch phone came out. It was the BlackBerry Storm. I remember who got it in my grade, all that. I remember when my brother got his first phone. I remember when internet wasn't a thing on phones and you had to pay for it if you did want it. We started out with flip phones. My dad had a BlackBerry. I always remember the phone on the wall with the cord. Yep. Everybody had home phones. Like, I still to this day remember my home phone number and my neighbor's, so I could call and hang out with my buddies. I remember that whole atmosphere, and like when kids got a telephone, but it only had 4 buttons and you could only call 4 people. Yep.
So you still experienced that part where we weren't operating through them and they weren't a part of our daily every second life.
Correct. Now, I will say my dad was definitely on the forefront of a lot of that technology, so I did see more than the average person.
Yep.
But I thought I didn't have a sense of what life was like before and after. But what I didn't realize is that I'm the first real full generation that grew up on eating out, and we will see how that affects our health moving into the future.
Okay. So how are we going to pair this into our conversation today? So Nelson talks about in Becoming Your Own Banker, the average Joe. And the reason our mentors have told us that Nelson said this often, the reason that he used the average Joe is he wanted us to realize that this is not any kind of hyperbolic thing when it comes to becoming your own banker. Anybody with the willingness to rethink their thinking can start taking over the function of banking in their life with long-range thinking, not being afraid to capitalize, not stealing the peas, which we've talked about the grocery store example. Don't do business with banks and rethink your thinking. That's his 5 key principles. And those principles pretty much work in any walk of life in some way, shape, or form. So he was so focused on the average Joe, and that's not a negative term. He was just saying, hey, the average American has 30 to 35% of their money that they don't keep. He would refer to it as a headwind. So Brock just said he's the first generation that grew up eating out. I can vouch for that because I just had the conversation last week at the beach with friends of ours. We didn't grow up going out to eat. That was a treat. Like, if we got to go to Ryan's and we got to have the buffet once a 3 months, we were living high on the hog, as they say out here in Texas. We were excited. And my kids think that going out to eat 3 days a week is normal. So it's a very good point that there are always going to be these things creeping in almost silently that eat at our income earning potential or our money or our wealth. And what does Bob call them in the LEAP book? Eroding factors?
Yep. Wealth eroding factors.
Wealth eroding factors. And he kind of goes through them, and technological creep is one of them. Now you and I, go ahead.
Technological changes, planned obsolescence. Planned obsolescence is the fact of we get an iPhone, but we don't get to keep that iPhone for very long. Eventually, it starts wearing off, and we eventually have to get a new one.
Man. So let's segue that into our topic today. So we're continuing to expand on our last episode where we started with what does it look like to create your own banking system through dividend paying whole life. We kind of journeyed through the beginning thoughts of that. And Nelson makes a statement on page 22 that not too many people are familiar with the concept of getting better no matter what. And so he uses an example of a Boeing 757. And so let's kind of just touch on what he's referring to and keep in our back of our mind for those listening for the first time. How many times you've thought to yourself, man, I'm making more money now, but I can't get ahead, or where's all my money going? I hear this all the time. And it reminds me of what Nelson said is once we know what the problem is, then we'll know what to do, which then also allows us to ignore a lot of the noise. Because everybody thinks I got to go get a higher rate of return. I got to go make more money. In reality, if we build ways to keep more of our money we earn, then we can create new opportunities better because opportunity finds capital. So Nate, Boeing 757, how the heck does that tie to money at all?
Yeah, I think it points back to the fact that people who read Nelson's book often say it took me 4 or 5 times reading it to really start connecting the dots in what he was trying to point out here. But the idea with the airplane example is tying or connecting the dots of an engineer in an airplane and an engineer in a life insurance company. And so the engineer in the airplane doesn't just factor in, will it fly? Like, that's not the only consideration they have to make. Will it fly? They also have to factor in the amount of weight they can carry. And I mean, there's all kinds of different variables besides will it fly? And so the point, the analogy that Nelson makes with the airplane is that an airplane will work very, very hard at full capacity, which means if its fuel tank is completely full, I don't know what the weight of a jet fuel tank is, but I would imagine it is quite a bit. Mm-hmm. So at full capacity with a full cargo, everything, this thing will operate. But as your fuel starts to burn off, the airplane still has the ability to work at the same capacity, which means it is becoming more efficient because it's becoming lighter. And so what Nelson is trying to help people understand is the same way an engineer thinks about an airplane is the same way an actuary thinks about a whole life policy. And what is very, very different in the financial world is understanding that there is a financial tool that we can use that gets better no matter what, because it is engineered to get better no matter what. It's going to be working just as hard, but it's going to be more efficient.
So on that note, Brock, give us a high level. So Nate said a couple of words that may be new to somebody who has no clue about becoming your banker. So actuary, I remember the first time I heard that, I was like, what? Because I had no background in the insurance world at all. What is the role of an actuary, and how does that tie into Nate in the 757? What is he talking about?
Never knew what an actuary was either until in college. I was in classes with them, which is funny. And
hey, the actuaries in my brain, do they fit the common stereotypical mold, or is it unfair? We'll talk about that later.
Hey, we know some actuaries, so
We do.
we can't
And they don't fit the
we can't
common
put them
mold.
all in the same box.
That's true. That's very true.
you can, you get them in class. They're the same. And so, in layman's terms, an actuary is a really smart person who's really good at math and really good at statistics. They pull a bunch of data together and they basically set the rules for gambling of, if this many people go into this scenario, here's what's going to happen to this number of people, and here's what's going to happen to these number of people. And they just know by the law of large numbers and massive amounts of data what's going to happen. And that's why it's so important for insurance companies and why it's a pretty sure bet on how their products work. And I can go deeper into that if we need to.
Well, let's stay there for just a second. So I got asked this question yesterday. Hey, Brandon, I understand Nelson's principles. He's already read the book 3 times, I think, about paying premiums at a company that has been around for 100 plus years. That's a mutual insurance company, dividend paying for 100 plus years. He said, I get that. But he said, how do these companies make money to honor the contract that I'm going into with them, which he understood was a private contract, which is a very awesome thing, unlike anything that we're used to in the legal world today. He said, how do they make money? So Brock, at a very high level, combine what an actuarial mindset does, or Nate, whoever, and how they are factoring in profitability of a company and why that's so important to the reality of we're going to die and they have to be as efficient as possible.
Great question. So first, let me touch on the fact of, when it comes to actuarials, science, and life insurance companies, if you think, if we just siloed Penn Mutual, for example, Penn Mutual Life Insurance Company, they have been around since 1847. And I can't rattle it off the top of my head, but I have seen the paper where it talks about how many people they insured in the first year, 10 years, 20 years, and then what they have today. And if you think about that I think is 178 years or so of record. That means that they have thousands upon probably hundreds of thousands of people who have gone through their life insurance company, that have filled out a life insurance application, that have taken a health exam, and have owned life insurance policies with them. They're probably going to know pretty closely how your life is going to shape out when it comes to death and disability, because they've seen hundreds of thousands of people over time. Okay. So if you know that from a relative standpoint, then you wonder, how do they make money? Well, number one is mortality expenses. That comes from the actuarial part. What they're going to say is, we're going to predict that $100 million of death benefit is going to be paid out in this year. Well, if they determined 100 million, but only 90 million paid out, Well, then 10 million is profit. That's number one. Number two is fees and expenses from their own policies. So term insurance, which has shown that less than 2% in the history of the world have ever paid a claim, and they're most profitable in the year after. The fees on like index universal life, variable universal life, all those different products. So you got the fees and expenses within the products. You've got the mortality expenses. You have other things like policy loan interest. When we borrow against our policies, we're not borrowing from ourselves and we're not paying ourselves back. We're paying the insurance company back. That interest is revenue to the insurance company, which can be profit. And then the next is their own investments. Some of the largest and best and greatest investors in the world are mutual life insurance companies. They own things like corporate bonds. They own things like commercial real estate, massive projects within the business world where they're turning massive amounts of revenue and profit. Well, revenue minus expenses equals profit. And over time, that is where all of those profits comes from. Mortality expenses, products that don't produce value, immediate, and basically their investment returns.
That's a great explanation of what's really going on behind the scenes. And Nate, one of the things that people get to the forefront of when they really understand how mutual companies work is they go, oh, I am just paying as much premium as they will allow me to, relevant to where I am in my life right now, to put my money in a place that is more sound in how they think about money and do calculations than anywhere else that we know of. It's really that simple. And then how I go utilize the features of that private contract is when I send it into the world and I try to create money coming back to me, hopefully in some way, shape, or form. And what I love to say to people often, Nate, and maybe you say it a different way, so touch on this, is we know just by paying a premium, which is a privilege because we have to qualify with our health and our wealth. You can't make any money. You can't be broke and qualify for insurance hardly. You can't be super unhealthy and qualify for insurance. Major things. Okay, so we're already separating ourselves because they don't ask you for those things when you go to the bank for a traditional loan, in the same regard. They just want to know about your money. So when we know that, Nate, we have to realize that they've been profitable companies, all the companies we work with, for 100+ years straight.
Brandon, how do you know they've been profitable?
Because they return dividends, or they have a dividend that they share with their policy owners at the end of each year. Okay, we're going to touch on dividends here in just a minute. Now, Nate, when you first started, you probably only knew of dividends in one area. Did you have any context of whole life and dividends and how that all worked together?
Before I knew anything about this stuff, I knew what a dividend was in the traditional sense. The only context I had of dividends when it came to whole life insurance is essentially what Dave Ramsey tells people, which is that it's a return of premium. They're just giving your money back to you. And the real easy way to debunk that statement is, if that was true, you would never have a cost basis that you exceed.
All right, Brock.
Hold on, Nate.
Yep.
I'm going to say yes and no. You're kind of wrong in that. The reason that is there and the reason we have to have a cost basis is because of the way life insurance is taxed, and they are classified as return of premium due to cost of basis for the what's called FIFO method in tax. First in, first out. And so what that means is, yes, they are classified as return of premium. I would say that it can be debunked because you can get back more than what you've paid into it in dividends.
Yeah.
That's definitely a better way to say that.
Why do I know that is the case? Is because you can show in the actual life insurance premium the dividends paying for the premium and you still collecting dividends, or you completely stopping premiums on a whole life insurance policy, and dividends continuing to be paid for years on end, right?
Yeah.
If there is a return of profit. So what that means is on the FIFO method is you can take all of the dividends out of the contract or withdraw money out of the contract up to your cost basis tax-free. If you were to withdraw past that, then they would become taxable.
Let me give a simple example. If your policy, you had paid $100,000 in premiums, $100,000, and you could withdraw up to $100,000 because that's what you put in, because that's all money you've already put in. There would be no tax implication there. What Brock's saying is if you drew out more than that, then you're going into the tax implication world. And that's where Nelson was so good at reemphasizing over and over again. The product of whole life is just being combined with the process of thinking and acting and building a system like a bank, and how we control the function of banking and financing the things that we're going to do in life anyway. And that gets missed so often.
And Nelson also has a good scenario or example. I don't remember what book this is in. I think it's in How Privatized Banking Works, or
Building a warehouse of wealth, maybe.
No, it's in the Case for IBC, where he had a State Farm policy, which I don't totally recommend, but he had a State Farm insurance policy that paid dividends. And as an example, he started taking the dividends in cash. But one year he got a letter that said, Mr. Nelson Nash, if you continue to take dividends, you'll be taxed. What would you like to do? And he just ended up putting them back into the policy.
Yeah,
well,
that's one of the
another parts of that policy is, Nelson makes the point that if I would not have had elected the dividend option for that long, it would be even greater than it was. But he said my dividend was 10 times my premium by that point. He said I had a $300 it was a very old policy that he got back in the 50s. It was $300 a year, and it was paying a $3,000 dividend.
And that right there brings us back to, if you haven't listened to the episode about the grocery store, this is what Nelson was trying to get us to understand, is that you can create a place like a bank, and he just used the grocery store to help us connect to what all of us have experienced going into a grocery store. And so, do you want a little bitty grocery store, or do you want a real big grocery store? You want less shelves or more shelves to put inventory on, i.e. capital that flows through your life. And so when we understand that, this is about long-range thinking. And there's a line in the book, Nate, somewhere, I think it's on page 48, 49, which we'll get to eventually, where he says the average Joe takes about 15 to 20 years to get the banking world out of their life, the traditional banking world, to replace the banks. Now, that's a whole nother conversation for a whole different day. But what I love about that is I will say to our members often, we don't hang out with people that are average. Because if you begin to lean into this and learn this and implement this, you're going to want to increase that and be above the average line. Because an average is the sum of a bunch of different people. Okay. So when we think about that, we understand dividends. And Nate, I had this conversation in Brock yesterday. I was visiting with a fairly new member who's been a friend for 10 plus years. And he was running all of his calculations of like thinking, because he's a super numbers guy, on the guaranteed side of the current in-force illustration he had. Okay. And I said, hey, I'm not saying that you shouldn't do that. I love your conservative nature, because he already is taking over the banking function with the cash value he can borrow against. But I said, I've had policies for 7 years that have been the same or better on dividends from the original illustration. Brock, will you break down how that could go up or down and what guaranteed and non-guaranteed means per the contract as a simple explanation, so that, because the first time somebody looks at an illustration, if they have no context of insurance, or they've only ever been sold insurance off of an illustration, it can create a lot of confusion.
Sure. Yeah. So when you look at a whole life insurance contract, there's 3 components: the premium, cash value, and the death benefit. As it pertains to the cash value and death benefit, there's a guaranteed side and a non-guaranteed side. Guaranteed side of the illustration, that is worst case scenario. What that means is there is no dividend ever paid within the contract. So, for example, if this was Penn Mutual, that worst case hasn't happened in 178 years. This is your guaranteed base contract. There's no dividends. It's just the guaranteed growth of 3% minus the first couple of years where there is cost of the insurance.
That's good.
Then there are the non-guaranteed side, which includes the dividends. Illustrations are just projections. They're not actual things that are going to happen. They're going to be so much different than what you put in. Okay. Non-guaranteed includes dividends. Dividends are not guaranteed until paid out because dividends are profit of the insurance company. You do not know what your profit is until the end of the year. It could be more, it could be less. You'll just receive whatever they give you. It's kind of the black box of the whole insurance industry because every insurance company credits them differently. And some will say, hey, we raised our dividend. Another company might say, hey, we raised our dividend. But what they don't say is one insurance company raised their expenses too, while another one didn't. And so you just have to be a little, I would just say, accept it with good grace that you're getting one and you can think through, I'm going to get one. But the also other part is the fact that once a dividend is paid and it goes, you put it into the contract, you can't lose it anymore. Like it's there. And now that is your new guaranteed floor.
That is a very important piece. Go ahead, Nate.
I think it was maybe been Ryan Griggs, and this isn't groundbreaking information or anything like that. But when he talks about dividends, he says a dividend is essentially an overestimation of the cost of operating the company and an underestimation of the performance of the assets. That's essentially what it boils down to. And a premium is part of the engineering process for the life insurance company because they are essentially setting the cost of insurance and setting up their based off their operating cost. But they're also building in a little bit of cushion because they're like, hey, we want to make sure that even in a down scenario, we still maintain the ability to operate and function. So at the end of the year, they see the performance of their assets and they see the operating costs and they see, what we talked about earlier, the profit, and then they share that back to the policyholders.
And if they are a prudent company that has continued to grow, they're going to keep some of that profit back for unforeseen occurrences because we can't predict everything. So it's almost like planning for the unplanned, which I love because it's always factored in their calculations. Let's be sure that we're sound in thinking in 30, 40, 50-year chunks. So here's the best example I can give that I heard. So Nate and I were listening to a panel of actuarial scientists for 5 different companies 2 or 3 years ago. Now, here's the funny thing. They did not record it because of that black box you're talking about, Brock. And so they wanted to be able to be very transparent with the knowledge they have now, which I'm fine with. It makes perfect sense. They don't want to go on record as saying this will always be the case because of that non-guaranteed side. But the guaranteed side, our mentors did a great job of saying, if you just worked off the guaranteed side and you began to understand the power of taking over the banking function by being your own banker, you're still going to be creating a better environment for your money to go, even if you never got the dividends.
Well, Brandon, let me also touch on that because that was at the same time that panel was back in 2021.
Yep.
2021. 2020. Yeah, 2021 or 2020. Actually, it was 2022. All right. Because that was the first year that we were actually all back in the same room together because we did it virtually in 2021. So 2022, that panel, because one of the biggest concerns that people brought to the conversation was COVID. Hey, what are the mortality tables are going to wreck the insurance? I mean, there was all kinds of rumors about life insurance companies that were going to have to shut their doors because the mortality rates had just gone through the roof and all this stuff. And these actuaries said, we've done 10 to 20 year stress tests based off of new mortality rates, based off of what we've seen. and we still are profitable.
Well, and another thing that came out of that, Nate, that is right in line with that is I'll never forget one of the companies that we do business with said we paid the claims, now that they had enough data looking back, all out of monthly cash flow. Did not even have to dip into any books of investments that were 30, 40-year thinking. Now, Brock, I didn't fully understand this. And when I say it to people, I really make sure they let it sink in that a mutual company is required to honor our contract when we have a whole life policy. And one of the ways they do that is they always make sure they have 100% of the death benefit available for their entire portfolio. So touch on that for a minute, Brock. Like, what does that really mean compared to anywhere else we've ever put our money?
Man, I feel like I'm getting all the hard questions today.
You are. You can handle it. You have don't you have a degree from Vanderbilt or something like that?
Sometimes, yeah. So that means, so if you were to think of this in two lights, in the fractional reserve system that we operate within in the United States of America, for every $1 that you deposit into a bank, they can then turn around and lend out $10 to $13. With an insurance company, they can only give out $1 for $1 that's deposited. And what a lot of people don't know about, we're not going to dig into, but life insurance companies are state regulated, not federally regulated. So they have different state attributes that they have to go with. And so when an insurance company, if you were to look at their balance sheet, they have a 1-to-1 ratio of money liquid to money that could be paid out if everybody died tomorrow. And if you wanted to borrow against your policy, they have $1 for that cash value. Because if we need to take a step back, cash value is just the present value of the death benefit into the future. The death benefit is a promissory note. Cash value is what you own today. It's like a home. It's the equity, not the sale price. Okay.
Good stuff.
Thank you. So they just have $1 for what's there.
So I think that's another important point about whenever we do request a policy loan from our policy, that is a real that's not just numbers on a screen. That is a real dollar that is being transferred to us. It's very different than if I call up the bank and I say, "Hey, I need a loan," and they just punch in the numbers and voila, the money's there. The money we receive from our policy represents real dollars. And the reserve requirements that these insurance companies have to maintain with the state board of insurance for every state that they operate in, they often have many, many more times than their reserve requirements on hand. Some insurance companies have 600 to 800% over and above their reserve requirements. And so the fact that they're not fractionalizing our money is really powerful, because you can go all the way back to the Great Depression. At that time, there were banks that had tightened up. There were banks that were shutting their doors. There were banks that were no longer lending money at that time, where life insurance companies were still loaning money out because they had it to lend.
Yeah. And Nelson, if we simplify all that, Nelson comes from the school of thought that's called Austrian economics. And just at a very simple level, it's sound money thinking, which is what Brock and Nate have just described. That's it. It's at a simple level. That's how my brain understands it. It's not more complicated than that. You can't lend out more than you have. And that's directly related to, for us individually, how much premium we pay, which comes from Nelson's don't be afraid to capitalize. Back to the grocery store example. If I want to have a lot of room and inventory opportunity, I need a bigger grocery store. How do I do that? I have to build it, because I can't do what the traditional fractional reserve banking world can do, which is print money. Okay. So it takes more time. And that's an important piece that often Brock, I would say it's almost hard to really understand until you keep living this and using it, because every other thing we've ever experienced is the opposite of this. When you save money in a savings account, fractional reserve banking, legal contracts, those are all things that are different than what a whole life insurance contract is with a mutual company. They have completely different characteristics. And so it's very hard for the brain to go, oh, is there really something different there? A different place where I can put my money first that gives me all of these attributes and benefits that are complete opposite of the traditional financial world. And when we realize that, then we're starting to really get into the understanding the problem. Because if we'll lean into that and go, well, why is this the case? You know, I had a member the other day with kids getting close to college, and they said, does my cash value have to be reported? So my cash value in my mutual company policy, dividend paying for 100 plus years, does it have to be reported on the FAFSA? No. They're like, kidding me. And I said, if you really lean into why that is, you'll get more clarity of why you're doing what you're doing. She goes, but my 529 plan for my kids has to be on there. Who created the 529 plan? And this is where you can really help understand that whole life insurance is not a byproduct of the government. It predates it. I'm going to say that again. Whole life insurance is not a byproduct of the government. It was around before. Brock, at a simple level, here's your last our question of the day. What does that mean for somebody who's never heard that before? Like, we don't think about contract with our money. We just think I'll save it at Chase Bank and they're going to take care of it for me. How's that different than putting money into a premium at a whole life policy, on a whole life policy?
I'm sorry. Are you asking me the hard question of what does it mean that the insurance company was around before the government?
Yeah,
Or
let's do that first. I think that's important.
I believe we
Predates
gained
the
our
income tax code.
I believe that we became a country on July 4th, 1776, and life insurance was before July 4th, 1776.
There you go. Great job. Great
Thank you.
job. All of us have lived what, Nate? What have we lived being used to? What is the norm that we grew up in as far as money and contracts?
Well, I mean, tax law, you know,
Yep.
instead
I
of
agree.
contract law.
So to answer your question there, Brandon, we have grown up in the age of defined contribution plans, not defined benefit plans like families before us. We also grew up in the era of, 401k, which is defined contribution plan. 401k, put all your money in the market, save for the nest egg, retirement from the industrial age, all these things. And if you look back at the statistics, it's like in the year of World War II, so of 1942, if you looked at Americans as a society, 50% of Americans owned whole life insurance and had their money there. Since then, it has just progressively gotten away from that because of the common acquisition of stocks and bonds and how easier it is to do it now, and 401k plans and IRAs and all that.
All right, so that's a great place to stop and really segue into the next topic, which we're going to be really talking about the basic understandings, which is just one page in a review on 26 and 27 of Becoming Your Own Banker. If you're listening to this and you're like, I'm intrigued by this, but I've never read this book, you can find this book through our website, cashflowlegendz.com, and you can also find it in any of our connected social media platforms. If you want to read it, we recommend buying it off of our website, because then you kind of get to hear our story. You're going to pay the same price for the book, but you get to hear how we got to where we are today. Nate and I didn't wake up and go, we want to sell life insurance. That's the last thing we thought we'd ever do as careers. We are teaching and living the process of becoming your own banker and the infinite banking concept. Dividend paying whole life insurance just happens to be the best place and product to do that through. And Nelson's book does a great job of explaining that and teaching that. And it will take multiple reads to understand it. It's not a book you read once. It's a book you reference depending on seasons of life. And make no mistake about it, we all deposit money somewhere. We all will deposit money somewhere till the day we die, or some medium of exchange somewhere. The question is how much of it will you control, be able to reuse and pass to your next generation and your next priorities as you're doing that and making those deposits, or premiums, as we would say in the world of insurance. So looking forward to connecting next week when we record again. Guys, great job. Brock, great job of handling all the tough questions. Nate told me to give you all the tough ones today, so you're welcome. He did.
I did not say that.
He didn't say that. We're really grateful for anyone who listens, shares, rates us, ask a tough question. The algorithm apparently loves all that, and we would be talking about this whether we hit record or not. So we do not take lightly that you would share your time with us, which is your most valuable asset. And when you learn how to keep more of what you earn so you can earn more of what you keep, what it really leads back to almost always is the ability to have certainty and control in how you use your time. Money is just a tool that often creates that and the mindset we have around it. So until next time, hope you have a great evening. See you again soon.